did look a bit odd when the FTSE 100 opened 70 to 80 points lower this Tuesday morning, especially as the US stock market had closed pretty strongly the night before. But that wobble now looks a bit more understandable in light of Prime Minister Theresa May's announcement of a snap general election for June the 8th. However, stocks may not remain rattled for too long if the opinion polls and if history both prove a reliable guide this time around, though I accept that's a pretty big if on both counts. Our analysis of general election results since the inception of the FTSE All-Share in 1962 shows that the index has tended to do better, on average, under Conservative Prime Ministers. Please note, this is a view based purely on the data and is in no way an expression of political preference on behalf of my employer or myself. Now, the figures may therefore offer some comfort to investors who are nervous, especially as Mrs May looks to have a big lead in the opinion polls. In addition, the historic data also show how the midterm elections of 1966 and 1974 failed to derail stocks. In this case, however, the UK stock market seemed unconcerned by either the party affiliation of the person in charge or the size of their majority. As we can see here, there's no correlation apparent between stock market performance and a government majority. So while Mrs May will want to add to her party's haul of seats in Westminster, this may be less of a concern for investors, at least relative to the overall result. History also suggests that the market prefers a win for an incumbent Prime Minister, again irrespective of their political leanings, perhaps as this means the markets are dealing with a known quantity, although the performance differential over a full term in this case is relatively minor anyway. However, the recent opinion polls' sketchy record and the dangers of using historical performance as a guide to the future mean that stock market investors are unlikely to take too much on trust, and they remain pretty edgy till the result becomes known on the 9th of June, given that policy on such huge issues as Brexit and Scottish independence, as well as the state of the nation's finances and economy, are all set to be a source of fierce debate once more. Even so, the key thing to do here is not to start tinkering with your portfolio too much if you can resist the temptation. Yes, by all means make sure you have a balanced portfolio designed to weather a range of economic and political scenarios and not just one. Horrible to admit as it is, none of us has a crystal ball and we're all capable of being wrong, so preparing for such an outcome is just a common sense precaution. But no, don't start trading and dealing like a dervish. While we can see that there are certain correlations between election results and the stock market, this does not necessarily equate to causation. Remember, company share prices and valuations are ultimately determined by profits and particularly cash flow. Unless you think the election result on 9 June will lead to the implementation of policies that could directly and materially affect a portfolio position's cash flows, you're probably better off doing as little as possible, despite the political uncertainty, as that means you won't incur the commissions or the frictional costs which can come with trading and which do definitely erode your total portfolio returns over time. Thank you for watching, and I look forward to seeing you next time.